and welcome to you all from a gorgeous Sydney autumn noonday to our latest in the IMAP series of Managed Account webinars. Today we're going to be looking at two issues which each in their own way are central to the process of giving advice. Today we're going to be looking with Charles Stodart from Zurich at the global markets outlook and what that might mean for the portfolios that are constructed for retail clients, where the risks lie, where the opportunities lie, and the things which as an advisor or portfolio manager you should be thinking about. Then we're going to look at another of the big issues which faces advisors and licensees, and that's the way in which best interest obligations play out for advisors. I've come just before this webinar from a meeting with the FPA and a number of other industry bodies to look at forming common view on the way in which CPD is created, managed and provided. And best interest, CPD, the FASEA obligations, these are all part of the substantial ramp up in the process of giving advice and the infrastructure that a licensee or an advisor need to understand and to have in place to be able to give systematic, capable, structured advice. So today we're going to be looking at two different topics, but each in their own way, absolutely central to the process of creating advice, delivering it to clients, creating substantial ongoing relationships that enable retail clients to meet their goals. First of all, we're going to hear from Charles Stodart. Charles is an investment specialist with Zurich and has a long career in investment management. So without further ado, let me hand over to Charles to take us through where to from here in the markets.
Thank you, Toby. And I'll slide across. Just let me forward through to the slide which will be relevant. Jenny, can you help with the slides? Just a few teething issues. Anyway, we'll really, I've got 20 minutes now to talk through, to give you a market update. And really, what I'm looking to do is to give you an assessment of global macro developments that are happening and some general market trends. And probably most pertinent over the last few weeks has been what the impact is of tariffs. Now, we thought this had gone away to some degree, but it has definitely reasserted itself. And while the reaction by the markets has been pretty benign up until this point, it remains something that we need to be mindful of. And then finally, I just wanted to touch on where we believe some of the growth opportunities exist towards the end of the portfolio, end of the presentation. So I have to put up the important information slide. Now, clearly I'll be talking about some future market directions, but we know from recent events over the weekend around the importance of not believing the pollsters too closely. But clearly I'm going to be talking about some individual stocks. These aren't meant to be personal recommendations. So perhaps just before we look forward, it's worth having a look at where we've come from. And this slide here, I think, is incredibly useful in terms of giving you an asset class snapshot. Now, these are ranked by real returns, and quite simply, green, if it's green, it means that you're beating inflation, and if it's red, it means that you're underwater. And what we've seen, I mean, generally over time, green dominates, which is obviously a good thing, particularly for risk assets. But what we've seen in the last couple of years, really starting in 2017, has been this massive seesaw between excellent markets for investors back to disappointing markets in 2018. So what happened in 2018, it was really driven by a very ugly Q4. And that pulled 2018 negative. In fact, in the US, it was the worst December for the S&P since 1931. So this was a month and certainly a quarter that prompted investors to take note. The other thing to observe is that it was a very broad weakness. There was no real place to hide. These sorts of events are incredibly testing for investors. But I think coming out of Q4, it was a real reminder to investors after a period of actually what's been a very good environment, particularly for equities, is to upgrade the quality of what you have in your portfolio. Now, fortunately or happily, 2019 has been a far more positive story, at least until the end of April. And you can see some of those names like MSCI China have been very strong. In fact, the A share in China was up 33% to the end of April. So these are pretty compelling numbers. US is up about 18, and even Australia was pretty strong, up about 13. So these are obviously decent returns, and you see numbers like this and you wonder whether it's the adage of sell in May and go away. Well, perhaps it's most relevant after you see these types of numbers. But it's obviously been comforting to have that return, particularly after what happened at the end of 2018. And perhaps the strength of the rebound has been driven in part by that weakness. So what's really happened year to date? There's been a number of factors which have been suggested. One has been the receding threat of trade war, which seemed to be happening through the start of the year. Now that's obviously been parked. Trump has decided to up the ante on that, and we'll come to that in a bit more detail. But we've also had some stimulus from China, which is very, very important for growth in Europe, for Australia as well. And I think simply that bounce from pretty distressed market levels at the end of December was also a factor. But the key for the markets has really been a change of heart by central banks. And this is what this chart really shows you in pretty graphic detail. This chart shows you what the implied pace of rate hikes are in the US over the next 12 months. And you can see that towards the end of 2018, the market was pretty certain that there were going to be three hikes in the next 12 months. And that really did change very rapidly at the end of Q4. So at the end of 2018, the market was not looking for any hikes, and today we're actually expecting a cut. Now that's evident in not just the US. We've certainly seen that pressure on central banks to be more supportive in Australia, and we've also seen it in the European Union. And part of that has really been driven by pretty sluggish growth, but also by inflation, which continues to remain very subdued. In fact, the latest prints show inflation well below central bank target ranges. So at the very least, the market is saying, look, there's space for an insurance cut, just because the inflation numbers are so low. Now, we've had recent commentary from the Fed. The Fed's not being as measured as it has been in the past. We've seen changes of direction which have happened quite quickly. But Powell is still keen to emphasize his independence. And we've seen the Fed just remind the market that he wants to be patient. He wants to see sustained numbers that give him more clarity of direction. He really wants the data to be there. The market will push. Trump has pushed. I think Trump would like 4 cuts over the next 12 months, which would obviously help him, put him in pretty good stead for his election chances next year. But Powell has to show independence. Now, what about growth more broadly, which is probably the underlying support to the markets. And this next slide really looks at what's been happening across a broad range of geographies. And we can see that generally the darker the green, the more positive the number. And PMI is a Purchasing Managers Index. And that really just shows to the prevailing economic trends in manufacturing, but it's taken to be an indicator for economic activity more broadly. The second line down, the US, you've seen it started to ease up, but actually remains pretty positive, and that's reflected in employment rate or unemployment rate of 3.6% at the last print, the lowest since 1969. I mean, these are pretty startling numbers when you think about it, and you're seeing wage growth pretty subdued, but remaining stubbornly above 3%, which is, I suspect, one of the reasons why Powell in the US wants to play the longer game in waiting for the data to come through. However, other areas globally haven't been as strong. Japan, you can see, has been bouncing around that 50 level. That's the demarcation between expansion and contraction. And what we've seen more broadly in Europe is a relatively positive view in the first half of 2018, and that's really moderated at the end of 2018 and into 2019. So growth is reasonable, but the pace of it has definitely moderated. Towards the bottom, you'll see China, and it's come out of a period of reasonable weakness. It's been testing that 50 level, but it's actually been showing some improvement over the last couple of months, and that's really been helped by stimulus that's coming through. But I think the focus for China in the very short term has been completely captured by developments on the trade front. Now, this slide here is quite busy, but I think it really provides a good graphic representation of what's been happening on the trade front since the start of 2018. And there have been a number of different developments, and each step is clearly marked. And we had a flurry of activity in early 2018, and really in the last half a year or so, that flurry had eased off until the start of May. The important numbers here are probably the dark blue, which shows what's actually been implemented. There's been a lot of proposals. Sometimes it's hard to keep up with the tweets coming from Trump. He's been very quick to put new proposals on the table. But the actual level of the bars show the dollar value of US tariffs proposed. So when you're thinking about that, what is the impact? And it really comes through, and it will really manifest itself in two ways. It is an impact on growth, and it's an impact on prices. And really what we've seen towards the end of last year was the realization that there's a lot of talk, but the actual impact is quite muted. If you're thinking about tariffs dollar value of about 40 billion, well, putting that into context in the US sense, that impacts GDP by about 20 bips. So it's not a massive number, but it is a reminder that these trade wars clearly aren't helpful. They present a headwind for growth. Now, if all proposals are implemented, that 40 billion number goes north of 200 billion, and it starts to be a much more meaningful impact. And who is wearing that impact? Well, to date, it's really been industry in the US. We haven't really seen Chinese importers change their prices at all. And that's been, you're starting to see it flow through to consumers. So in the end game, if it continues this way, then you should start to see it reflected in inflation numbers, which again has some pressure on the Fed. China does have some leeways. This only shows the US reaction. It doesn't show what China's reaction is, and China's reaction's been reasonably muted to date. And part of that is because it doesn't import nearly to the same degree as the US, so the numbers are definitely smaller. But China has more, it has more tools up its sleeve, if you like. It can boycott US goods. It could change its policy regarding the renminbi. It can do a number of things which would have a knock-on effect. The lightning rod, if you like, at the moment is Huawei, which has been such an important provider of 5G equipment, and there's security concerns around that. So this trade tension escalation remains live. There's some hope that there will be a meeting of the minds, if I can put it that way, in late June at the next G20. And there's been suggestions that Trump and Xi will meet up. And the last time they did was in November last year, and that provided what followed was a period of relative calm. But this hasn't gone away. It is something that you, as advisors or as investors, we do need to be mindful of, because it is meaningful, or has the potential to be quite meaningful. What has China done to respond to that? Well, the blue line here looks at that PMI that I was talking about earlier, and we can see that it's drifted back towards that line of expansion contraction at 50. But they have responded. They've increased their aggregate financing, so they've made it easier for companies to borrow again, and they've done a few other tweaks or reforms in terms of tax rates, etc., to try and stimulate growth to some degree. Now, how that's been reflected in Chinese economic data recently has not been massively comforting. Retail sales have come through at about 5 or 6%, which is the slowest since 2003, and industrial production about 5%, so far from the heady days when they were punching out 10% numbers. But we have to remind ourselves that China is a far bigger economy, and that shift towards service-led takes time, and it is happening. But China's slowdown does matter. It has a massive impact on the health of European growth, and we see it close to home in terms of demand for our raw materials. So it has, by implication, an impact on Australian growth and the Australian dollar. Perhaps if we look more broadly then at what other capital markets are telling us, and perhaps the most interesting at the moment is the 10-year bond yields. And this chart really looks at the 10-year. The dark blue is the US 10-year, the lighter blue is the Australian. And we can see really in the last, the red box shows what's been happening essentially year to date. And we've seen levels on the 10-year that we've not seen from a long time in Australia. So the current level of the 10-year is fallen to about 1.58%, a mere 8 basis points above the current cash rate. It's a pretty startling numbers when you think about it in that context. Now, the US 10-year isn't plumbing new lows, but don't forget that the cash rate has gone up 200 basis points since its lows around about Brexit time. So when you take that into context, the cash rate versus the 10-year has gone from about 100 basis point spread to essentially flat today. The US 10-year is now just a touch below 2.4%. And this, for some commentators, has been a massive red light in terms of what it might imply for future growth. The so-called sort of recession indicator, the yield curve, particularly the 2-year and the 10-year spread, has been a pretty successful indicator of recessions going back. Now that still remains positive, but that spread is pretty skinny today at about 16 basis points. So the 2-year is about 2.2, the 10-year about 2.4. So it is something that you need to be mindful of. I mean, the one conclusion you take away from that is that actually the returns from bonds and cash in general are pretty unexciting. The other challenge for central banks wrestling with what to do with rates is what is the neutral rate of money? I mean, traditionally you look at the 10-year as being an indicator of the price of money in general, but this tells us that it's not really that clear what a neutral rate of money is. We talk about going back to a normal rate of money. I think that debate's still not been concluded. It may predicting recession, but it's definitely something for you to monitor. In the US, we've been looking at the 2-year, 10-year spread, which remains positive but just. And clearly, clearly that price of money suggests that returns from bonds and cash remains pretty muted over the next period. In terms of investor sentiment, this chart I always find quite interesting. It just looks at the American Association of Individual Investors. So there may well be quite a bit of behavioral issues tucked into there, but you can see just at the start of 2019 how concerned investors were. So dipping into the fear side of the gauge doesn't happen that often. It does happen occasionally, but not that often. And we can see that we visited that in early 2019. And that really sets up a level of, or the opportunity for recover. And we're back into more reasonable levels, but I think it's a real point to consider in terms of what are your cash levels. Have you been putting money to work over the last 6 months or taking money out? It's been such a volatile period that taking a step back and thinking how just essentially going back to the basics has been quite important. The other barometer of confidence has been around IPOs, and we've seen some of the mega unicorns that were called. So a unicorn is essentially a company worth more than $1 billion that's yet to be listed, and so called because they were at one point quite rare. They've become a lot more plentiful. But we've seen a number of these companies come to market over the last month with mixed results. Uber is probably the most famous of the names, and that listed in early May the 10th at $45. Interestingly, it's not traded above that IPO price since it's been listed, and it holds the slightly dubious record of the stock market debut that lost the most in dollar terms and more than any other American IPO since 1975. So some of these IPOs, particularly the ones where the earnings are a bit skinny, is something to be slightly mindful of. WeWork, which has become quite popular in Sydney as well in terms of places to work, is due to list as well. So one to keep an eye on. The one factor that I try to pull it back to is what's happening with earnings. Now, for us, macro does impact, and that might gauge how you're positioned. But earnings really remain the most important driver of stock returns for us over the longer term. And this just looks at what's happening in the US, but it's reflective of what's been happening in other markets. And you can see that last dark blue bar was what happened in the first quarter of 2019. Now, in the end, it wasn't as bad as people feared, and that can be supportive for equities. But it does show that over the next 2 quarters, earnings are going to be quite at the index level, are going to be quite thin. And you really have to look out into the Q4 or out into next year before you get back to something that's reasonable in terms of supporting that future driver of the market. Because with valuations no longer inexpensive, they're about 17 times in the US, you've got to have that earnings growth coming through to drive markets higher. But does that mean that equity investors should be fearful? Well, our belief is that this is absolutely the environment where things like transparency are more important, where active management becomes that much more important. And you have to look for where the growth is. One of our managers, American Century, that runs a global growth fund for us in a number of different formats, and in fact is about to launch a global SMA with Hub24, really points to some areas that investors can look to when they're thinking about identifying areas of growth. And their particular focus is on secular growth drivers. Cyclical was popular in 2016, 2017, but secular is now really important, and that can manifest itself in a number of different ways. 5G presents strong opportunities. Cloud computing, the likes of Alphabet. These are companies which are tapped into strong growth over the long term. Also, companies which have got highly visible revenue base. I don't know if you use Adobe, but these types of subscription type models are very powerful. And then likewise, or finally, companies which have got idiosyncratic growth drivers. So the philosophy for American Century is not the level of growth, it's the direction of growth which is most important in terms of driving returns. And even in an environment where headline growth is pretty thin at maybe 3% this year, there are still companies that are growing earnings substantially faster than that. You just have to go and find them. So in conclusion, or before we have a little bit of time for Q&A, global growth, I think, is clearly moderating, but it's not at dangerous levels yet. I think it's too early to be predicting a recession, but investors should be mindful. You have to be selective on equities, and you have to look through that headline number. Bonds and cash, the return expectations are pretty modest at the moment. And really, I think it's an opportunity at the moment for investors to be thinking about upgrading the quality of what they own. And with that, I'll hand it back to Toby for a little bit of Q&A.
Thank you very much, Charles. Now, at the bottom of your screen, you'll see that there's a Q&A button. So if you'd like to type in any questions, I'll moderate those for Charles. I have one, which I'd like to go back to this. I'd like to go back to this slide, Charles. So it speaks to the issue which seems to me to be really interesting is up until mid-2016, Australian 10-year rates were clearly higher than US rates. And I imagine if this was a long duration chart, that relationship would have persisted for some considerable time. We're seeing a gap of up to a couple of percent. Suddenly in 2018, in 2016 it narrows, 2018 it turns around. I mean, this is saying to me that institutional investors are prepared to accept a 1% lower yield from the Australian government than they are from the absolute cornerstone of global economy, the US government, for investing for a 10-year period. And that seems to me to be odd. I wonder if you might have comment on what is implied in that and what does it mean for Australian investors?
I think at its heart, it is a reflection on what the longer term growth opportunities are. So if you're thinking about what is a real rate of return, for me, that's what the 10 years is really trying to, is essentially pointing at. So I think that the prospects for growth are seen as being more positive in the US versus where they are in Australia. Now, is that reasonable? Potentially, when you're thinking about unemployment levels, if you're thinking about what the growth opportunity are for key drivers in the Australian economy, and that comes back to construction jobs, it comes back to financial jobs. I mean, these are key employers within the Australian sphere. So is Australia an economy that has got key growth drivers at the moment? Well, possibly. I mean, we're seeing a lot of, certainly in Sydney, we're seeing a lot of construction going on. And what that means, the new government in place, whether they're able to get consensus to push through on tax reform, etc., remains to be seen. But these are some of the things that have to happen to allow Australia long-term growth prospects to be improved, and I think that's been what's being reflected in the 10-year at the moment.
Right. Well, thank you very much. All right. Well, look, before I pass over to Andrew Fraser from Hub, I'd like to go back to just this slide here for a moment and just tell you a little about the upcoming events for IMAP. So, together with a panel of judges, Nigel Douglas, Brad Matthews, Dominic Cormack, Angela Ashton, and our partners at FE and Paul Saliba, we've been assessing the many entries for the Managed Account Awards over the last month or so. It feels like a lifetime. We'll be announcing the finalists in each of the categories: Australian equities, small caps, fixed income, international, multi-sector, licensees and innovation on the 30th of May, so next week. And then the awards presentations themselves will be the 20th of June. So I'm looking forward to that. We're right in the middle of it now. This year, we are holding our portfolio management conference in two parts. The first in Sydney in August, on August 6th, focuses on the higher level issues: asset allocation, portfolio construction, manager selection, risk management. So if you like, the strategic perspective on portfolio management. And then for the first time, we'll be taking the conference to Melbourne in October and focusing on the actual sector specific decisions. So this is security selection in Australian equities, international equities, and fixed income in particular. So I'm looking forward to that. It enables us to drill down to quite a degree on the issues around building portfolios for retail investors. Finally, we run each year a couple of times a responsible manager masterclass, focusing on the obligations of RMs with a particular focus on those who use or give advice or operate managed accounts, and we'll be doing that again on the 5th of June. So thanks very much, Charles. Now, let me hand over to Andrew Fraser. Andrew is the National Manager for Strategic Relationships for Hub24, and he's going to be talking about a study which Hub commissioned from Core Data on best interest duty. As I mentioned at the start, a central topic for so many advisors and licensees. Andrew, over to you. Thanks very much.
Thanks, Toby, and thanks for everyone for bearing with us through a few of those technical challenges. For the next 20 minutes, I'm going to talk to you about, as Toby said, best interest duty, where we are 5 years on from its implementation, and how technology managed portfolios have evolved in that time, and are now assisting advisors in meeting clients' needs and objectives, as well as supporting the best interest duty purpose. So the context we're going to give throughout this presentation is the white paper that Toby alluded to, a survey and white paper that we prepared in conjunction with Core Data, November last year, so right in the thick of Royal Commission season. And it looked at 3 cohorts of advisors, being your aligned advisors, non-aligned advisors, and self-licensed or own AFSL groups, getting their attitudes and thoughts on where we are with best interest duty and the future state of it. The reason we did this really was we see there has been an evolution in the assessment of best interest duty and how technology is really supporting that. Post-Royal Commission, we don't think there's been higher awareness on best interest duty, so we hope you find this of interest. So we'll touch on a little bit about the survey and its key findings. We'll then focus on some of the questions around advice, platforms, and tax management. And then we'll finish up by looking specifically at managed accounts and how they can help facilitate best interest duty. So a little bit about the survey itself. There was 56 questions as part of the survey, and there were 300 advisor respondees. Perhaps some of you dialed in today. The questions were created by Core Data in conjunction with Hub24, the AFA, and 5 industry participants, being advisors, to keep it real, as they might say. And the paper really examined attitudes towards best interest duty and how technology is playing in that space. Just looking at a few of the key findings now. At this point, I usually sort of throw it out to the crowd about whether you feel best interest duty has been a good thing and if it's changed the advice that you've been delivering. But in the absence of that, I'll take you through just some of the numbers that we've taken out of the survey. And what we've seen is that despite what advisors or the industry may have thought when BID was first introduced, 4 out of 5 advisors in the survey have agreed that BID was a necessary occurrence to raise industry standards. Now, the next statistic, and I'm moving on the top left-hand quadrant of the slide here, is that 66.3% of advisors either agreed or strongly agreed that best interest duty has led to better outcomes for clients. Now, there's an interesting contrast to that response in a moment, which I'll take you through. But 2/3 of advisors have said that BID was an important event or introduction for better outcomes for clients. Now, moving to the bottom left, we can see that there's 86% of advisors confirm that they received in-house training or from their licensee or a specialist provider. And 68%, so a little over 2/3, have said that they would be open to additional training ongoing. And we really see that's a bit of an obvious one. BID has evolved. We're seeing different attitudes towards BID and what constitutes best interest duty. And quite clearly, you could have a client come into your office tomorrow with a completely different profile, needs and objectives to the last 10 clients you see, and therefore will have different best interest duty qualifiers. So post-Royal Commission, we really see ongoing training in best interest duty as being a common occurrence at licensee PD days and ongoing forums. On the right-hand side, a few high-level findings which we'll dig deeper into shortly. When it came to investment product decisions and recommendations, by far the most important obligation when considering compliance with best interest duty for advisors was meeting the client's risk profile. It's a little bit of an obvious one, perhaps. We found that 1/3 of non-aligned advisors had moved since the introduction of BID to introduce into their business specific tax modelling tools and capability to support their recommendations. And that could be in the form of through their financial advice technology and software or through platforms. Third one down, when it came to platform recommendations, the primary consideration, perhaps no surprise, price was amongst that. Price and features were the two. I think they're perhaps unsurprising. We'll unpack that a little bit further shortly. The last point there in the bottom right-hand corner, however, I find an interesting outcome. So we talked earlier up the top that 66% of advisors agreed that best interest duty had led to better outcomes for clients. But 70.7% of advisors, so roughly the same amount of advisors, believe that best interest duty has had no impact on the quality of advice that they provide. So 2/3 of advisors are saying that it's delivered better client outcomes, and 2/3 are also saying that it's had no impact on the quality of advice delivered to their clients. And when we do this in other forums, we tend to get a lot of nodding of heads in that last point. So the interpretation of these points, we really rely on the verbatim answers that we get through the surveys. And what seemed to come through was that whilst the introduction of best interest duty may not have impacted or changed the quality of advice being delivered, it has put more rigour around the process. And so advisors are feeling more confident in what they're delivering, and perhaps investors and clients are also feeling more confident about what they're getting. And arguably, if clients are feeling better about the advice they're getting, then that's a better outcome. I'm going to touch now on ASIC Report 562. For those of you who aren't familiar with this, ASIC released their Report 562 early last year, and it was a survey or research conducted into the Big Four banks and AMP, looking specifically at advice given between 2015 and 2017, and specifically, again, they picked up 200 pieces of advice recommending super being moved from external products to the in-house aligned product. So a narrow scope, but that was the focus for this particular report. And you may recall the headlines at the time because the findings were sort of headline worthy, if you like, that 75% of those 200 pieces of advice were determined by ASIC to fail the best interest duty test. Now 75% is a pretty damning statistic by any measure. But when you dig deeper, more specifically, it wasn't that 75% was poor or incorrect advice. It was that there was a lack of supporting documentation around a lot of the elements of the advice. So the documentation or lack thereof was the primary deficiency identified by ASIC out of that research. But nevertheless, that latter part doesn't make the headlines like a 75% failure does. So from that point, we want to have a quick look at best interest duty and the safe harbour, the 7 steps of safe harbour. Now, there's actually 4 elements to best interest duty in the Corps Act. The first being 961B, which covers the 7 steps of safe harbour. There's also G, which is an appropriateness test. So overarching everything is the advice you're delivering appropriate for the client and their needs. H is the incomplete information. declaration, so if you're giving advice declaring that it may be on incomplete information, if that's the case, and L, which is an obligation to prioritise the client's interests over your own as the advisor. But nevertheless, what we see and know is that ASIC's first port of call when it comes to assessing compliance with best interest duty is the 7 steps of safe harbour. That's their first port of call. And in ASIC report 562, they identified and clearly called out that the 2 areas of deficiency were the 5th and 6th points on that list, being doing adequate product research and basing all judgments on clients' needs and objectives. Now remember, the deficiencies here were primarily a lack of supporting documentation. Around product research, particularly, that was with respect to the from fund or from product, if we want to call it that. So plenty of research on where the money was being recommended to go to, but inadequate or insufficient research on whether the existing fund, super fund in this case, could adequately meet the client's needs and objectives. A similar approach with the client's needs and objectives. So it wasn't to say advisors weren't considering that, but there wasn't sufficient supporting documentation. So off the back of reviewing the 7 steps of safe harbour and the Royal Commission, Commissioner Hayne has recommended, he wasn't a fan of the 7 steps of safe harbour. He believed that they created a rote process or a ticker box exercise for advisors to comply with best interest and took their eye off a genuine assessment of saying, am I acting in my client's best interest? As a result of that, his recommendation has been that safe harbour and the 7 steps be reviewed in 3 years' time to see if they are having a genuine impact on removing conflicts and delivering better advice. And if not, that they be scrapped. So stand by for more change, just what everyone needs. I'm going to jump now into the first and some of the slides or questions and results from the survey here. So the first one I'm going to have a look at, and I'll read them out, is which of the following issues do you consider most important in ensuring compliance with best interest duty? Now, these answers aren't mutually exclusive. There's nothing wrong here, but it's which of the issues do you consider most important? And far and away, the standout items here were basing advice on the client's relevant circumstances and identifying clients' financial objectives. And that really ties in with the ASIC findings and where they want you spending your time. What is interesting here though, I should call out the colours in the bar chart. The dark blue is the overall results, light blue is responses from aligned advisors, and the orange is from non-aligned advisors. But overall, rather consistent. Interestingly, is that the lowest priority was given to the question, or the point, having adequate information and research on products that may be appropriate. And by some margin, that had the lowest profile. And that really marries up and talks to ASIC's findings around inadequate supporting documentation on research of the products, particularly the existing product. So the next question, when making an investment product recommendation, in what order do the following issues rank when you consider your compliance with best interest duty? So in making an investment product recommendation. Again, there were 2 standout options here, being features and benefits of the recommended product, and if it matches the client's risk tolerance, which was the top rated item. So matching up the client's risk tolerance, features and benefits of the investment being recommended to top priorities. We found interesting the lowest priority in rank was whether it would improve the client's tax position. And in considering this further, our takeout from this point is that historically, when you consider this survey was neither platform nor licensee specific, the access to managed portfolios or platforms facilitating managed portfolios, and therefore investment vehicles where tax is really at the forefront of what they deliver, particularly in aligned channels, may not have been as widespread as it's becoming. And so we surmise from this that perhaps the access to those kind of vehicles hasn't been so great, and we would expect that to shift in time. The next slide is an equivalent question, but with respect to platform recommendations. So with respect to compliance with best interest duty, which of the following are most important when recommending a platform solution? And there were three equally high prioritised answers, being the price of the platform features, I think we would expect both of those, a broad menu of investment and insurance options, so flexibility for implementation, really. They were the three priorities for advisors when it came to compliance with best interest duty for platform recommendation. Again, and consistent with the investment recommendation, was at the lowest response was tax optimization tools. And again, we really think this talks to, in a non-managed portfolio world, and where platforms perhaps haven't had the functionality to really deliver value on the tax optimization side of things, the priorities on that is understandably low. But we do see that changing. And if we look at the next question, and I think the final one that we're going to look at is effectively flipping that question on its head, saying if a platform could add value to a client through active tax management, would you consider it important for compliance with the best interest duty? And in this case, the response was overwhelmingly yes. If the platform could deliver that, nearly 90% of respondees said that that would be important or extremely important in compliance with best interest duty. And I think this really talks to the evolution of technology in this space and how it's changing what best interest duty qualifiers are and how technology can help support advisors in that space. So now we're going to have a bit of a look at how managed accounts specifically, in conjunction with platform technology really, which delivers this, how they can help achieve best interest duty for clients. Now, what we know is that your clients don't come through the door and talk to you. They don't talk in the same language that we talk in. So they don't come in and say things like they want netting off of assets and CGT optimization. That's not what's on their mind. They might want to not pay too much tax. They might want to make sure they're not paying unnecessary fees, amongst other general lifestyle goals. So the question is, how do you dig deeper? What questions do you ask to understand what the true client needs are and how products or investment solutions you're recommending might tie into those needs? I'm going to go through now 6 elements of managed portfolios and platform technology that can talk specifically to client needs and objectives. The first of these is very simply fee savings through the netting of assets when trading. And at a very high level, if you move from one managed fund to another managed fund, it's a sell down of the asset. It's buy-sell spreads on the full value of the asset, and you buy into the new managed fund. And there could conceivably be 50, 60, 70% correlation in the underlying assets, depending on what space you're playing in and what type of funds you're looking at. In a managed account world, because the client is the beneficial owner of the underlying assets, when you move from one managed account to another, it only trades on the difference, on the non-common assets. So where you do have 50% correlation under the bonnet, you're only going to realise 50% of the trading, 50% of the trading costs and the tax outcomes as a result of that. So at a very high structural level for managed accounts, that delivers a transaction fee benefit and potentially tax benefit to clients. Number 2 is modelling CGT to help manager selection. So because you can get these differentiated tax outcomes using managed accounts based on commonality of underlying assets in funds or portfolios that you're switching from and to, it gives platforms the ability to model that and forecast it and say, well, what does the tax outcome look like if you move from portfolio A to portfolio B or C or any other platform or any other portfolio, sorry. So if you think about your historical process for selecting a new managed fund to replace an old one in your client's portfolio, and I'd hazard that typically things like performance, how you view the manager, research, and price come into play in determining which funds you're going to recommend. Managed portfolios add tax to that mix. You might have 2 portfolios that you really like, great managers, great performance, similar price, but one's going to give you a $2,000 CGT outcome and one's going to give you a $500 CGT outcome. So the ability to model that CGT impact is specific to managed portfolios, managed accounts, and absolutely can deliver beneficial outcomes for your clients. Still on the tax side of things, point 3 is the ability to manage portfolios, or manage portfolios allow tax parcel optimization at a client account level. So this one, if you bear with me, can be a little hard to demonstrate without an illustration. Consider you or your client might hold some BHP shares directly, and they invest in a managed account that also holds some BHP shares. And you decide to sell the personal BHP holdings. Now, because managed portfolios, or in a managed portfolio, a client retains beneficial ownership of the underlying asset. When you sell down the client's personal BHP holdings, you may find that the optimal tax parcels to reduce tax for the client for BHP may be the tax parcels that sit inside the managed account. Contemporary platform technology allows those tax parcels to be switched around within the client account, so the managed account remains intact, but the client has utilised the best possible tax parcels across their account, be it within the managed account or personally held, to get their optimised tax outcome. So, and there's no work involved in doing this. So these are automated, optimised tax outcomes for clients, and they only come to the fore in a managed portfolio environment because the client retains beneficial ownership of those underlying assets. Moving on to point number 4 is around substitutions and exclusions of assets. So quite simply, you have a client who comes in to see you. They might have an ethical preference. They might be an auditor and they can't hold specific stock. Or they may simply already hold a lot of a certain share because they've inherited it or they've been holding it for some time. Now, if you are using, and I'll draw a comparison perhaps here with a balanced managed fund, and your client comes in with those kind of preferences, a general scenario here is that you have to lose the efficiency of the balanced fund and either choose something different or build a bespoke portfolio. So you lose your efficiency to cater for that client preference. In a managed account scenario, you can set substitutions and exclusions on assets that the client either can't or doesn't want to hold. So if the client doesn't want to hold resource stocks because they've got an ethical bias, you can still invest in that balanced managed portfolio, but you can elect to exclude resources or other sectors or specific stocks from that portfolio. And then you choose how those assets get redeployed. So do you simply pro-rata it across the rest of the portfolio? Do you send it to cash? Or you direct it to another alternate substitute asset? And the important outcome here is that as an advisor and an advice business, you don't lose the efficiency of your managed account solution, but you absolutely cater for an individual client's preferences, needs, objectives, wants, and desires. So this really talks to individual clients' needs and objectives. Number 5 here is managed portfolios allow advisors to determine which assets are sold or retained to control CGT. And what we're talking about here is that let's say you were selling out of a particular fund, call it a balanced fund for argument's sake. If you're selling out of a balanced managed portfolio, you may notice that a particular holding has a very large accumulated accrued capital gain. And so you want to sell out of the portfolio, but you don't want to realise that capital gain on that particular holding. Again, managed portfolios, because of the ownership of the underlying asset, allow you to sell out of the portfolio, but exclude or pull that asset out of the trade. So sell out of everything else, but remove that asset and not realise that capital gain or loss as it may be for a client. If you contrast that with a managed fund environment, you have no ability to isolate or control the underlying assets within that fund when you sell. So this is about control to deliver client tax outcomes. Finally, we look at transparency, and this is probably one of the original benefits of a managed account or SMA, is that your clients have visibility through to the underlying assets. So if you have a client who wants to outsource their financial planning and portfolio management to you, but they want to stay in touch, they want to understand what you're doing in their portfolio and what's happening, then absolutely managed accounts deliver that with full transparency, not just of the holdings, but of the transactions and trades that are going on so they can see what's happening in their portfolio. I appreciate we moved through some of those benefits quite briskly, and naturally we'd be happy to revisit that in more detail with anyone at a later point in time. If I just wrap a few things up in terms of observations from Hub 24, there's no doubt the takeouts from the survey and other ASIC reports were that understanding clients' objectives and making recommendations, stating the obvious here, that tie in with those, supported by documentation, is absolutely key to best interest duty moving forward. We see there's no doubt, and the broader commentary and survey results that we find, that platform technology has a big role to play in not just delivering different investment solutions, but how they deliver that and tying those specifically in with clients' needs and objectives. And that will wrap it up from me for my part today.
Thank you very much, Andrew.
Thanks, everybody.
And as I mentioned before, if there are questions, then we'd be keen to receive those and to respond to those. There is a question which has come in about the slides, and the answer is yes, we will be making the slides available to everybody who participated in today's webinar. We also recorded today's webinar. Now, because we had the little break in the middle, I'm not sure how that will actually work, but we'll certainly splice it together with a bit of sellotape, assuming it works okay. Now, I have one actual observation about best interest, which didn't get touched on in the presentation, Andrew, and that is this: that the key difference in my mind, or a key difference in my mind, between managed accounts and the conventional advice-based advice service, is that for an individual advisor, remembering that the best interest duty is personal. If you're an authorised rep of a licensee, you are on the hook personally for best interest. Now, I learned at our Responsible Manager Masterclass in Melbourne this Monday that if you're an employed advisor, you're not. The licensee is on the hook, so go for it. No, I mean, there's a different level of risk, but certainly if you are an authorised rep, it is a personal liability. The key difference, to my mind, in respect of best interest duty, is that if you are in a conventional advice-giving model, hi Bob and Thelma, here's my portfolio recommendations for you. Hi Bob and Thelma, I think you should sell this and buy that. Best interest duty applies at an individual transaction level. And let me give you an example of a buyback on a stock in the portfolio. Clearly, some people will be generically advantaged by taking up a buyback. For example, all pensioners win, accumulators don't win. But of course, some pensioners may not be advantaged in participating in this particular transaction. Some may have, as Andrew said, individual preferences, which you have to take into account. So best interest duty applies at an individual transaction level if you are giving personal advice in respect of each individual transaction. Managed account, of course, the best interest duty of the advisor is that the managed account itself is suitable and that the safe harbour tests or whatever replaces them are complied with. At which point the transactions then become, as they do in a unit trust, the manager's responsibility. And just as a responsible entity of a unit trust has a best interest duty, the responsible manager of an SMA or the MDA provider of an MDA has that best interest obligation. What it does is removes from each individual advisor the transaction level obligation or liabilities that best interest duty creates. And that seemed to me to be a too little understood benefit that operating a managed account gives to advisors. So, look, thank you very much for your attention, everybody who's out there. Andrew, thank you. Charles, thank you very much. And we look forward to our next webinar, which is on the 11th of June. So same channel, stay tuned. Thanks very much.